Welcome to the Tacoma-Pierce County Association of Realtors monthly market update. I am your host, Amy Remington with Guild Mortgage, and I am lucky enough to be here to tell you all about what happened in August and what we're looking forward to in the month of September. Now, August was very much like July in as far as interest rates are concerned. We did see a lot of capitulation. Things got better, and then things got not better, and then things got better, and things got not better. And there's so much that drives interest rates that I wanted to get into just a little bit more as to what happens to the mortgage market and what specifically impacts mortgage rates. Now, we did have a Fed meeting that kind of kicked off the whole month, and it was at the end of July, but August was definitely a month that was really looking at two major indicators. One of those indicators, of course, is inflation concerns, inflation worries, and the second one is job strength. So how is the job market doing? If we see a significant amount of inflation, that is scary to mortgage rates, and I don't know if I've ever told you guys why. So bear with me here for a minute. We're going to do a little bit of a understanding as to why inflation is such a difficult thing for mortgage rates. Now, we're the only country, by the way, in the world that does 30-year fixed rates. Everywhere else in the world, they will do adjustable rate mortgages or balloon mortgages where they're fixed for a little while and then they need to either be refinanced or paid off. But we're the only ones that have done the mortgage-backed security thing and that are able to do this. So when you're looking at a long-term risk, I want you to, for a minute, take off your hat as a real estate agent or take off your hat as a buyer or seller, and I want you to think about mortgage interest rates from the investor point of view. So let's just say you've got a couple $1 million that you want to throw into the market and you're looking to invest your funds. So let's just say hypothetically that I borrow $100,000 from you and I say, okay, we're going to set out 30-year fixed rates. We're going to do a 7% interest rate. Rates right now are in the mid sixes. So you're like, sweet, this is totally going to work for me. You decide to, we make a contract, you give me $100,000, and then I give you your first installment of that interest, which would be $7,000, because we're just doing a simple interest calculation here. So you go out in the world and you metaphorically have a cart where you put in goods and services and things, and you spend this money. And then we go around another year and we're again doing interest only. So I give you $7,000 again, and you take that shopping cart of goods and services and you go out in the world and you buy stuff, but you notice, I'm getting a little bit less stuff for my money. Well, this continues as inflation increases the cost of the stuff that you buy. That does impact your return. So we go 5 years into this and you go, Aim, I am not loving the goods and services that I'm able to get with the $7,000 you're giving me. And I go, ho, we have a contract. I'm giving you $7,000 a year on this $100,000 and that's it. And then at the end of the term, I'll give you the $100,000 back. So you can really see in a visceral way how inflation absolutely impacts that yield. Now, as an investor, you have two choices at this point. Either ride it out, you get what you get, you don't throw a fit, or you say, maybe there's someone that can buy out this note. So let's say that you go to our friend Maxwell by chance and you say, hey, man, I've got this 7% interest rate and I've got this $100,000 that Amy's borrowed, which is cool and all, but I need my money back. And Maxwell goes, well, he pulls out his calculator. He's like, I'll give you $90,000 for it. You're like, whoa, wait a minute. I gave her 100. You're guaranteed 100. You're like, yeah, well, if I give you less money, then my interest rate or my yield will be better. So as an investor, you're kind of in a double loss situation. You either ride it out and inflation eats into it, or you don't ride it out and you take a loss up front. So that's why inflation is so fussy with fixed mortgage rates. And it really can impact those interest rates we see on our rate sheet every single day. So during the Fed meeting, there was a couple folks that thought, well, gosh, maybe we should raise interest rates a little bit. Maybe we should make that change to try to calm inflation. Now, the thought process here, first of all, Fed rate changes do not directly impact mortgage rates. Sometimes we'll see the Fed funds rate increase and we'll see mortgage rates drop. When you increase the Fed funds rate, what you're really increasing is the rate in which banks buy and sell. They lend money to each other. It's called the overnight lending rate. So if you have somebody who, hey, I need $3 billion for 24 hours, the Fed will lend them that money for that interest rate, and then within the next 12 hours or 24 hours, they pay that back. So it's an overnight lending rate between banks because balances ebb and flow. So when the Fed say they're going to raise the short-term interest rate, what that really impacts is your home equity lines of credit, your credit cards, your personal loans, your savings rate, if you're at a local bank or institution that uses the Fed funds rate, the prime rate. So it impacts a lot of those, but it doesn't directly impact mortgage rates. Again, what majorly impacts mortgage rates is the inflationary rate or inflationary concern and the strength of the job market. The reason why the job market has such a significant impact here is because the job market if you go into the Wayback Machine, so sit with me for a minute, we're going to go into the Wayback Machine, back into the 70s, into the early 80s when we had double-digit inflation. Now, a lot of folks will look at rates and they'll say, well, historically, they're low compared to, yeah, but you can't really count anything before the beginning of the interwebs for it to really be an accurate reflection. If it took days or weeks for news to impact the market, it's not the same market we're in now. It has a completely different impact. So in the Wayback Machine, when we had double-digit interest rates, we had double-digit inflation. And the reason we had that is we had this little animal called wage inflation. Wage inflation is extremely difficult to tame. Wage inflation says, hey, I'm doing a great job over here at Guild, but XYZ mortgage company is going to pay me 20% more to do the same work. And employees leave employers en masse, so employers have to pay more, which sounds great, and it is as long as it's not widespread. If it's widespread, that then kicks into wage inflation. So they're watching jobs to make sure that there's enough weakness that the economy is still stable, but there's not wage inflation. Good example of wage inflation. During the zombie apocalypse, we had some folks that we had high demands in jobs, and we had other folks where they couldn't find work. Same kind of a situation. You had pockets of wage inflation. So that was a really recent example, if you understand what I'm saying. So if we've got calm inflation, we've got calm rates. If we have high inflation, we have high rates. So that kind of gives you an idea of what we're looking at on the day-to-day. August was a bit of a roller coaster. We saw some positive signs of inflation coming down, so mortgage rates responded positively, and then the opposite was also true. So it was definitely an up and down. There's not really a definitive, this is when you should lock your rate, or this is when you should buy, or this is when you should sell. Like we've said before, the best time to buy or sell real estate is when you're really ready. As far as September moving forward, you know, we're looking at more of the same until we see some kind of resolution with the conflict in the Middle East. We are going to have some inflationary concerns there. And there isn't economic data that we're expecting to be life-changing, that will absolutely change interest rates. What will lower rates is low inflation and a very weak job market. If we start seeing unemployment increase, we start seeing some weakness in the economy on different levels, that will lower interest rates. So that's going to do it for your August update. I'm Amy Remington. It has been my pleasure to be here with you today. Have a great one.